Well, let's focus on another earnings reaction. Then we had KEI Industries. That's the next management on the show. The stock is under pressure. The street seems to be a little bit disappointed in the revenue growth as well as the margins, though the gross margins did increase a little bit. Mr. Anil Gupta, the chairman and managing director at KEI Industries, joins us on the show. Hi, Mr. Gupta. First look at the numbers actually looked quite good. You know, the revenue growth has been quite good. So let's clear a couple of factors. Exports, they contributed a larger chunk to the revenues. So could you tell us what is the rough percentage it will contribute for this year itself, point number one? And point number two, if you could help us out, what was the domestic volume growth in your core business?
Good morning. The export growth has been substantial. It could have been more given little setback in revenue from US, but still we have been able to make up. And exports are now contributing around 17.5% of our total revenue in the second quarter. And if I see the first half, it is around 16.5%. I hope that we will be able to maintain around 18 to 19% of export of our total revenue in this financial year. We have grown by around 22% in this quarter in our wire and cable segment because of the fall in the revenue from EPC department. We have already stated in our past several years that we are reducing our EPC business, and that is under that policy. So the overall wire and cable revenue has grown by 22% in this Q2.
So I want to ask you, what is the volume growth in the domestic business? Exports have done phenomenally well, and I think that is margin accretive. You could correct me on that one. Exports are margin accretive. And also, what is the domestic cables and wires volume growth?
See, total volume growth in domestic and export is around 15%. You see, we have to look at the revenue in totality. We have shifted some of the capacities to exports from our domestic side because of the opportunities available there. So whatever capacities are available, we are utilizing them full, and wherever we can do better, we are shifting.
Okay. So domestic, did you lose volumes, or was it a lot lower than the total volumes of 15% because exports outperformed?
No, we did not lose volumes. Maybe 1 or 2% lower. No, not more than that.
Okay. So is this the strategy, sir? The strategy is going to be to ramp up exports and maintain your domestic market share. Is that a fair way of putting it?
Exactly. We are continuously ramping up exports, but while improving the domestic as well.
Got it. What about the margins then? Your gross margin, there was a bit of an uptake, but other expenditure went up. Because of that, the margin expansion may not be as much as what the street expected. From here on, how do you see margins move? The problem is that commodities are going on a bit of a melt up. So in the near term, there could be some kind of impact, maybe quarter 3 or maybe quarter 4. How do you see margins pan out from here on?
I expect margins to remain between 10.5 to 11%. So far as commodity prices are concerned, copper and aluminium prices are concerned, I have said in the past also that we don't expect any impact due to that, because we are adequately covering our metal purchases and metal inventories vis-a-vis the order book.
Sir, for the full year, when we last spoke to you, you had guided for, I think, about an 18-19% top-line growth, and cables and wires at 25%. Now, considering the first half, you are exceeding that run rate. What is the full-year guidance now? Can the full-year revenues be in excess of 20%? I mean, do you have the confidence to up the guidance? And what is the second half looking like?
I have guided that our wire and cables revenues will be 20% plus. And I still maintain the same for the whole year. Incidentally, I never said that it will be 25% plus. But
apologies.
Hopefully we will try to reach out there. But my guidance is 20% plus.
Okay.
Right. And
overall? So for the full year, what is the guidance? I think you had spoken about 18-19%. And in the first half, you're tracking at a 22% run rate.
Yeah, yes, exactly. So the full year, we will definitely try to aim around 20%. Right. But because we are able to achieve that.
Okay. And sir, second half of the year, what is growth going to look like for you? I get the full year guidance, but if you could provide some nuance on what's happening on the ground and what we should expect.
We are seeing good demand in domestic as well as our export markets. And I don't see any letdown in our performance in the second half as well, in the third and fourth quarter. I'm sure that by fourth quarter, when our partial capacity in Sanand comes into full force, we will be able to improve our performance from the fourth quarter.
Right. But you spoke about the Sanand plant. Could you give us a sense on where you stand on that as far as timelines of commissioning are concerned? Is there a delay? If yes, then what could the lost sales on account of that be?
Yeah, there is a delay of around 3 months, and
Okay.
we are going to commission first phase of the project by November. And but the full plant will be operational by March 27. I can't quantify that what will be the loss of revenue because of the delays, but as per the guidance, we should continue to grow by plus 20%. Year after year.
So phase 1 that was expected in September, that gets commissioned now in November, and the entire plan that the street was working with somewhere midway through FY27. Now you're saying by the end, quarter 4, it'll be fully commissioned, and there's no risk to these timelines, correct?
Yes, correct.
Well, always good speaking to you, Mr. Gupta. For the time being, the street seems to have expected something more on the growth, on the margins, as well as maybe a little bit disappointed on pushing up these timelines. But we take your guidance on board and wish you well. We'll keep tracking all these numbers as the quarter progresses, and wishing you and the entire team a very, very happy Diwali.
Thank you very much. Thank you very much.